Hi there, I'm Irk, and this is my channel Get Irked, where you can learn how to invest for the long term. If you visit my website, www.getirked.com, you can follow along as I make moves in 3 different portfolios. I have investments in play, my oldest portfolio, which started in 2011, my speculation in play portfolio, which I started in 2018 along with the website, so it's almost 3 years old, and the one I'm going to talk about today, the pandemic portfolio. I started this portfolio 1 year ago in May of 2020. I wanted to create a portfolio where my readers could follow along right from the very beginning to see all the trials and tribulations that go into making a portfolio from scratch in the middle of a situation where we didn't know if the market was going to sell off. So today I'm going to introduce you to the 8 different stocks in the portfolio. Each one of these stocks was chosen because it could survive both in a pandemic recession and out of one. So they're all quality stocks for all time. One of the other key characteristics that I wanted was that each stock would have a dividend. For those of you who don't know what that means, sometimes a company will pay its shareholders the profits it makes in the form of a dividend, which gets paid out quarterly, semi-annually, or annually based on how many shares each shareholder holds. That dividend is represented as a yield. And the way you calculate the yield is you take the amount that's paid out per share and divide it by the share price. And that would give you a percent. That's the annual percentage yield. Right off the bat, I think some of you are going to look at this and say, Barrick gold? Like you're really going to invest in a gold miner? And my answer is absolutely. With all of the money printing that's going on, the only way that you can protect against inflation is with the time-old tested trials of gold. I also trade Bitcoin, as you may have seen in a previous video. However, in the last couple of weeks, we've seen once and for all, Bitcoin is not a store of value. It's a great speculative asset, and it might have long-term growth, but for the meantime, anything that sells off 50% or more within the matter of weeks does not store value. Gold, on the other hand, does not see the upside to the same extent that we see in Bitcoin, but it does hold its value more. So you might be asking, okay, well, why don't I buy the ETFs, GLD or IAU? Well, there's a couple of reasons. First off, gold doesn't give a yield. That's one of the complaints that a lot of people will have about it when they're anti-gold. However, the gold miners do give a yield. They do have dividends that pay. In addition to that, the gold miners see more volatility. They'll actually see more upside. So when the price of gold goes up, the price of the gold miner stocks will go up even more. And the same in reverse. Finally, I'm not a conspiracy theorist, but I've seen enough manipulation of the paper markets, the IAU, GLD, SLV, the ETFs that represent the gold and silver metals, supposedly, can easily be manipulated by the big banks. JP Morgan is regularly fined millions, if not billions of dollars for manipulating this market. That's not why I'm holding gold and silver, so I don't want exposure to that. As for Barrick Gold, or GOLD, they are the best in breed gold miner. And right now, they have a dividend that yields 1.495%. Now that might not sound huge, but when you think that a really good savings account is paying out 0.5% annually right now, not only do you get the upside of the potential of gold going up in value, you also get 1.5% per year. Next up, we have Costco, ticker symbol COST. I absolutely hate retail. I do not buy retail at all. The reason I hold Costco is, although you might not be aware, it's not a retailer. The majority of Costco's profits come from its membership fees. That's where they make their money. In fact, most of the time, the products they sell with such a low margin that they almost make no money on the products at all. The profit isn't there, so it isn't really a retailer. In addition to that, it's one of the retailers that people are going to continuously go to no matter what the economic situation is. You always need toilet paper, paper towel, and food, and Costco has that. In addition to that, it's got a good environmental social governance, or ESG score, which is becoming a more popular way to invest. Plus, it has a dividend. It's not great, it's 0.835% right now, but that's better than a sharp stick in the eye. Next up, we have Crown Castle, ticker symbol CCI. Many of you might not know who these are at all because it's kind of an unfamiliar name. They build the towers that support mobile services, so they are a 5G play. In addition to that, because they own real estate, it kind of makes them a real estate investment trust. In the past year, they had activists go into Crown Castle, and it's completely transformed the company. It has skyrocketed since I originally bought it. When I got in, my yield was about 3.5%. But because CCI increased so much in value over the past year, the yield is now about 2.8%. Next up, we have Digital Realty Trust, or ticker symbol DLR. And you might be saying, wait a second, Irk, that's a real estate investment trust. Doesn't that violate diversification? And it would, except I have Crown Castle for a 5G play, not for its real estate play, and I have Digital Realty Trust as a cloud data play. What Digital Realty does is they own data centers. So all of this movement of enterprise software into the cloud is playing right into Digital Realty Trust's hands. And I think for the long term, they're going to have really good prospects. Additionally, being a real estate investment trust, they actually have a good yield. It's still over 3%. Next up, Microsoft, ticker symbol MSFT. And you might be thinking, okay, wait, no, that's tech, that's growth. It is, but Microsoft is one of the most stalwart tech companies that you will ever see. Over the past years, they have constantly held up, even under extreme sell-offs. This makes them the company I want to be in, especially since they're diversified. They have Office, of course, the 365 cloud offering, but they also have Azure, which is their data cloud storage service. And of course, they have the Xbox division, which makes them a video game play as well. This is great exposure for one company to have that kind of asset base. Additionally, just like all of the other stocks in the portfolio, they do have a yield. It's not even 1%. It's like Costco's. It's 0.897% as of this recording, but that's still great because a lot of growth tech companies don't offer a yield at all. Next up, we have PepsiCo, ticker symbol PEP. Now, this might sound boring and it might sound like sugar water, but the reason I went with Pepsi instead of going with Coke or KO is Coke only has beverages. PepsiCo owns Frito-Lay and has a huge snack division. They did very well in the pandemic and they're still doing well now. Currently, Pep's dividend yield is nearly 3% at 2.907%, and that's great. Next up, a company that might put a lot of you to sleep, healthcare, and the best in breed in the healthcare space is UnitedHealth, and their ticker symbol is UNH. I hold them because no matter what happens in terms of an economic crisis or situation, everybody will still need healthcare, and UnitedHealth has proven over and over again that it knows how to make money. Additionally, it has a dividend yield in excess of 1%. It's currently 1.214%, and that puts it in a great spot to cover the healthcare sector in this portfolio. Last but not least, one man's trash is another man's treasure. Ladies and gentlemen, waste management, ticker symbol WM. And you really might be thinking, wait, you've gone off the deep end, Irk. That's a trash collection play. And yes, it is. What happens when the economy reopens? Infrastructure plays take place, everybody starts building, and what comes from that? Trash. Lots of it. There is no better player than Waste Management, and over the past year, they've done exceptionally well. In fact, I wasn't even able to get as big of a position as I wanted because they rose too fast. On top of that, they still have a really good yield of more than 1.5%. At the recording of this video, they earn 1.635%. So now that you know the players of my portfolio, how has it performed over the last year? Well, you have to remember I like buying in stages, which means I don't buy the positions all at once. So I wasn't able to get as much of each position as I really would have wanted. That being said, I never had more than 40% of my portfolio invested. Even with a 60% cash position, my portfolio is currently up 9.065% from May of last year to now. Now, of course, the S&P is up more than 46% in that time, but again, this was a conservative approach with 60% cash, and it still earned more than what the S&P does on an average year. Year to date, the pandemic portfolio is up 6.903%, which makes it a really high quality portfolio. I'm going to be looking at adding to all of the positions on the way down. And if you want to follow along, get on my website, getirked.com. You can see monthly updates for the pandemic portfolio. And if you sign up for a free account, you can see what my stock buying prices are, not just for the pandemic portfolio, but for the investments in play portfolio as well. If you're looking for other things to do, check out some of my other videos. Please like and subscribe, and I'll see you in the next video.